So the jobs number is noisy, so I want to dive into taxes. 20% corporate tax rate. Is it a red line?
Wait. The job number was noisy. It's still pretty good numbers in there. We're down to 4.1% unemployment, and when you look at the U6 number, down 1.5% for the year, we're bringing a lot of people back into the workforce, and that's what President Trump said he would do, and we're excited. We're not seeing wage growth in the job numbers, and that's why we need tax reform. And so, that's what we're working on. We're working on tax reform because we believe that tax reform can get us wage growth. Yes, the 20% corporate tax number is a bright line test for us. President Trump has said that we have to be 20% or below because that makes us competitive with the rest of the OECD world.
Gary, is it 20% up front, or would you accept a phase-in?
We'd accept 20% starting January 2018.
Would you accept a phase-in beyond that if you had to budge?
Look, we want to be as flexible as we can because the most important thing we can do for the American citizens is to get tax reform done. So we're trying to show as much flexibility as we can. As you know, we've only really sort of had a bright line in two areas, which is the corporate tax rate and making sure that we deliver middle income tax cuts. The sooner we get the taxes down, the more stimulative they are, the more we drive wages where we can finally see some wage growth in the country. The quicker we get middle income tax cuts down, the more consumers have more disposable income. Those are important for us, so we really need those rates to kick in 2018.
So Gary, what's more important, getting a win done fast or a 20% corporate tax rate? Would you give up a little on the tax rate to get it done sooner?
Look, I think we can do both. I really think we can do both. I think we can get a win and we can get the rate down.
That's the ideal scenario, Gary. I just want to know where the preference is. Is it the timing or is it the right plan? Is it the 20% line eventually?
I think the 20% line is very important to the president. That is a bright line test for him. And so far, as you see in the House bill that the Ways and Means Committee put down yesterday, they start with the 20% rate in 2018, and they continue it through the entire cycle.
Gary, I want to talk about the policy around repatriation. When we first had these discussions, it seemed that you were using the carrot approach, an incentive for these companies to move money home. Now it just looks like a straight-up tax, a pay-for. It looks like a stick. And I'm just wondering why the nature of the tax has changed, why that approach has changed, and whether you endorse it.
Oh, we've always endorsed a deemed tax. When you're switching from a worldwide to a territorial system, you really have to do certain things to switch the systems. So the repatriation tax and the deeming of that repatriation tax is a one-time catch-up in switching of the systems. So yes, we are endorsing what the House Ways and Means Committee has in their bill.
Gary, would you accept, though, that that's not very business-friendly, not allowing the companies to decide themselves whether that rate is attractive and therefore deciding themselves whether they want to bring the cash home?
We would accept that it's a lot more business friendly than the system that they have right now. And we've talked to many of the companies that have cash offshore, and we have had very little pushback from those companies in repatriating their money. In fact, many of them are excited to bring their money back to the United States and invest it here where they think they can get better returns on their capital.
Let me tell you what the Koch brothers say. They criticize it. They say it could increase consumer prices.
Well, that's one opinion. We've got many other opinions that don't agree with that.
Okay, fair, but what about the idea that they don't get to decide what they want to do and that they have to have other consequences to begin with?
Look, we can't go from a system, a territorial system, where you're allowed to fully move cash around and say that people that move their cash around prior to the change in the system when we're in a worldwide system paid a tax, and those that happen to wait got to avoid the tax. A lot of what we're doing in the tax code is trying to make it fair for everyone. The repatriation tax and the one-time deemed tax is a way to make it fair. A lot of this has to do with making the system fair.
Okay, so let's talk about fair. Let's talk about the mortgage deduction change from $1 million to $500,000 cap. Why is that good for the economy if you crimp the housing market?
Look, as you may or may not know, but we've studied this a lot. People don't buy houses because they get to deduct their mortgage interest. People buy houses because they have a good job and they feel good about their job and they feel good about their future prospects. They feel good about the economy and they feel that things are going to continue to go better and better in the economic cycle. The ability to deduct interest is a component that allows you to buy a bigger house, but it's not what drives you to buy a house.
Gary, the Tax Policy Center says that they would reduce the percentage of taxpayers using it from 21% to 4%. 4%. That's material. That fundamentally changes the structure of the housing market.
We do not believe that to be true. There are many countries around the world, many countries that did not allow deductibility of interest, and guess what their home ownership rates look like?
Okay, fair.
Similar to ours
Gary,
in the United States.
Gary, we've talked before about how the White House looks at the stock market reaction to see sort of what their policies are doing, and the home builders are telling you the market does not think this is a good idea.
Well, I wouldn't judge the market reaction over a 24-hour or 30-hour period on policy that's going to be in place for decades.
Gary, we caught up with a guy called Lloyd on Wall Street yesterday. You might be familiar with him, and he said the following: I can't say this is the moment where you want the most fiscal stimulus in the market. GDP last registered 3%. We're mostly at full employment. What have you got to say back to Mr. Blankfein over at Goldman?
I've got to say that if you looked at today's employment data report, you had no wage growth. We have had stagnant wage growth in this country. Our tax plan is designed to create wage growth. If you saw the report from the CEA, they talk about the fact that when we lower business tax rates, we're going to deliver real wage growth to American workers. That's what we're trying to do.
Gary, just to wrap things up on the Federal Reserve, we've had the nomination for the Fed chair. I'm just wondering when we're going to hear from you guys on the vice chair and the rest of the nominations to fill the board. Is that something we can expect before year end still?
Yeah, I think you can. I think the president made a great selection yesterday in Jay Powell. We're going to be meeting with Jay in the next couple of days here, and we're going to be getting some input from him on vice chairman. But the president has been working very rigorously on picking out vice chairman, and I do think you'll hear something from the president this year on vice chair.
Gary, a lot of talk on the Hill from Republicans with support for John Taylor for that vice chair spot. Is that someone you'd endorse as well?
I think there's a lot of names on the table right now, and we're working with Jay, and the president is quite involved in that search as well.